All right, after our budget exercise we did the other day, we're going to talk a little bit more about consumers and savers and investors. So let's get started. First thing I want to talk about is just teenager spending. It makes you a consumer, a saver, and investor, hopefully. A consumer is anyone who buys goods or services for personal use. So obviously, as a teenager, you guys do the same thing. You are consuming items. You're buying goods that you want for personal use, whether it be food or clothes or shoes. All that stuff will make you definitely a consumer. Some spending here to maybe scare you a little bit. $107 is the average amount of money that teens spend per week. You don't need to write this down. It's just some good information here. 29% of teens that spend more than $100 per week. 60% of teens receive money from their parents' income. 45% of teens earn money from odd jobs, and 56% have savings accounts. Again, you don't need to write these down, just some good stats for you. Here's what we need to write down. So, sources of income. Well, first, as many of you know, the main source of income for many people is work. And when you work, you either earn a wage or a salary. Now, let's differentiate between the wage and the salary. A wage is when you are going to work an hourly rate, and what you might make is $10 an hour, minimum wage maybe. And then how many hours you work, you multiply that by how many dollars you make, and that's your wage. Okay. You can get overtime for a wage. If you work over 40 hours, you get overtime, which would be time and a half. Salary then, this is paid on a weekly, monthly, or yearly basis. This is basically one sum each week or each month, no matter how many hours you work. You can work 60 hours a week and you still maintain the same salary. Teaching is a great example of this. I might put in 55, 60 hours on a week during the school year, and I'm getting my salary for that. But then, obviously, in the summertime, I'm working way less than that, but I'm still making the same salary. So it's a year-long thing. I might be working overtime hours in the school year, but I'm not getting paid for those overtime hours. But I'm not working hardly at all in the summer, and I'm still getting paid the same. So salary is a difference there. Wealth is defined as the value of the things you own. Your net worth is your individual's wealth after the debts and other obligations have been subtracted. You can also earn wealth and earn money through rent. Rent is the payment for the use of someone else's property. So if you have a rental property, you can earn money that way. You can also earn money as interest. Interest is defined as income earned from allowing someone else to use your financial capital. Okay, so again, if you have maybe $10,000 that you're going to let your buddy Johnny borrow, you can charge him interest on that. So you know that you're going to get money back and you're going to make some more money on that as you go. So there's some different ways to earn an income. So now I want to talk about factors that influence wealth accumulation. So why can't you, when you graduate high school at 18, earn $100,000? Well, you might be able to at one point, but these are some factors that are going to influence that wealth accumulation. First, your income. What income you have at your job is going to make a difference about how you end up influencing your wealth. Expectations, current interest rates, and taxes. These are all going to be different ways that influence your wealth accumulation. The election's coming up here, and all the time during an election you hear about taxes or interest rates, especially taxes. The nominee is going to lower this tax, and this president's going to not lower this tax, and that's going to help you, get more wealth in certain ways. So we did the budget thing exercise on the other day, and saving. Saving is important. Saving is when you set aside income for a period of time so it can be used later. And actually, Americans are bad at saving. A few years ago, I read an article where we saved an average of a negative 0.5%. How do you do that? Well, credit and credit cards. They get in the way there. But saving is very, very important. And we do a terrible job of it as Americans on the whole. Savings account, this is an account that pays interest with no maturity date. Funds can be withdrawn with no penalty. It's very liquid. And what I mean by very liquid is the fact that it can easily get your money. There's no penalty for it. You can go to the bank. I want to take out $100 on my savings account. You sign a little piece of paper. They give you $100. There you go. Okay. There's no fee for it. It's not hard to get your money. Okay. But you're also on the other side, you're not earning much interest on that as well. You're not earning a lot of money in there. Whereas if you have other avenues of saving, maybe a CD or a Roth IRA, you're going to earn more money. Therefore, it's going to be harder to pull your money out. You have to have a fee or a penalty. Okay, but you don't with the savings account. Same thing with the checking account as well, or with most checking accounts. Money market deposit account, or an MMDA. This is an account that pays high rates of interest, but it requires a minimum balance and allows immediate access to funds. So a little bit different from a savings account. A savings account may not have a minimum balance, especially one this high. A money market account usually has $1,000 to $2,500 of minimum balance required. You can only write a few checks a month from this, but it is insured by the federal government, and we'll talk about that in a little bit as well. But a little bit different here in the savings account. A little bit more advanced. You're going to get a little bit more of an interest out of this because you're having more money in there, and you can only write a few checks a month from there. So that's a little bit different from a savings and a checking account. I mentioned the CD earlier. CDs are known as certificates of deposit. These are time deposits that state the amount of the deposit, maturity, and rate of interest being paid. So basically, a time deposit is you have to keep your money in there for a certain amount of time, or you are going to have a penalty. Okay? So a CD is going to talk about the amount of the deposit, maybe it's $1,000, when it becomes mature, and the rate of interest being paid. So maybe it's $1,000 and it's a 12-month CD, which basically means that if you remove your money before the 12-month period, you will face a penalty. Okay? But in return of that, if you keep your money in for the 12 months, they're going to pay you a higher interest rate to keep your money in there. So again, at the bottom here it says offer high interest rates to savers, but pay a penalty of cash before maturity. Okay? So they might offer you 3% interest on your $1,000 12-month CD, okay, which is a little bit better interest rate than a savings account or a checking account. But they're banking on you keeping it in there for that 12 months. If you decide to pull it out, 10 months, man, I need some new tires for my car. I'm going to get my money back. Okay, you're going to pay a fee. And you know, depending on how much that fee is, it might depend on each bank. So I'll talk about insuring your money here. The stock market collapsed in 1929. Really good video down there of A Wonderful Life about the stock market run. One of my favorite movies of all time, Jimmy Stewart, Donna Reed in there. Great movie. You should check out this little clip here about the stock market run on this little town. But what happened here is you have a run on the banks. So if you don't know this, the money that you have in your account is really not all in the banks. They don't have a little account in there with a little safe with James Laughlin money in it. No, my money I have in there is out, and it is helping other people, with loans on a car or loans on a house or loans with, home improvement or whatever it might be. And what happened during the Great Depression is all these people went to the banks to get their money. Well, the banks don't have that money. So therefore, they basically had to, the banks went under. They couldn't pay these people, and they lost all their money. So President Roosevelt, when he became into office, he signed legislation to protect your money in there. It's called the FDIC, or Federal Deposit Insurance Corporation. Okay, let's see that right there, but the Federal Deposit Insurance Corporation, FDIC. And this means your money is insured up to $250,000 in each bank. So if you're lucky enough to have $500,000, I wouldn't have it all in one bank. I'd make sure I have it in 2 or 3 banks. Okay, so this basically says that if the federal government, if the bank goes under for whatever reason, that if that bank is FDIC insured, your money is up to $250,000 insured in that bank. So you'd hope you have it in different banks where you can make sure that you get all your money back. And that is all for this episode. We're going to talk about saving and investing a little bit more on the next episode.